The other concerning thing is, Ashish, the numbers coming from US, they're not like saying that, it's something happened in last decade. They're saying that it is happening after 3-4 long decades, and some of the numbers are really showing the way that you will have a long period of underperformance from US markets, and as a result of that, some of the emerging economies like India can have long duration of underperformance or maybe a recessionary period. Do you tend to agree with this statement?
No, see, I think that if you allow me, Vikas, I would like to just to discuss what you mentioned that, okay, if US is likely to underperform for, say, a longish period of time, does it mean we will necessarily underperform, etc.? If you don't mind, I would like to share a
Sure,
couple of
please.
slides here for the attention of our audience, and yeah. So, Vikas, can you see my screen?
Yeah, I can see that.
Yes. So, since you are discussing about US and, possible recession and slowdown and impact on us, let's look at this data. It's quite interesting. I'll quickly run you through it. Basically, if you see, first of all, I would urge you to ignore the last two, the graphs which I'm putting the red pointer here, just ignore it for the moment. Let us focus on the part which is on the left-hand side of the dotted line, which is basically these four graphs. So there is a top half which says total return in US dollars. And then there is a bottom half which says earnings growth in US dollars. And what are we comparing? Total return and earnings growth. What are we comparing? MSCI India, S&P 500. And we are comparing 2 decades, 2000 to 2010, what happened? And 2010 to 2020, what exactly happened? Let us just compare that. Now, if you see the decade of 2010 to 2020, if you see the decade of 2010 to 2020, India's earnings growth in US dollar terms was negative 1% compounded. So we know that 2010 to 2020 economically was a washout, and the earnings growth of Nifty companies was barely 3-4% for the full decade. Here we are comparing India and US, so obviously we will discuss in dollar terms. So if it is 3-4% growth in rupee terms, then obviously in dollar terms it will be minus or zero. So 2010 to 2020, Indian companies' earnings growth in dollar terms was practically zero. In the same decade, S&P 500 companies' earnings growth in dollar terms was 8% compounded, right? Consequently, 2010 to 2020, India's index, we gave zero return in dollar terms, and US index delivered 11% compounded in US dollar terms. So first thing is a obvious, begs an obvious question that right now, a lot of us are very, very worried that if the US has a recession, what will happen to us? So we can always ask a very innocent counter question that in the previous decade, US was booming. How did we benefit out of it? You can see in this data, we did not benefit at all. And the obvious answer is that domestic conditions matter because 2010 to 2020, we had 2G scam, coal scam, corruption allegations, the government changed, a new government came. Immediately, RBI came with asset quality review, 10 lakh crores worth of NPAs, demonetization, RERA, GST, all that could go wrong, it happened. It ended with ILFS default, credit crisis, COVID. So basic point is that 2010 to 2020, the US was actually booming. We didn't participate in that boom because our domestic conditions were bad. So ultimately, domestic conditions matter. So let's go to the previous decade, 2000 to 2010. In this decade, Indian companies' earnings growth in dollar terms, 14% compounded. American companies' earnings growth in dollar terms, only 2% compounded. So as a result of this whole decade, India's index delivered 12% compounded in dollar terms. US index did not grow at all. And by the way, 2000 to 2010 also was just as bad because 2000 started with tech bubble crash. Then the World Trade Center was blown up. After that, global financial crisis. So 2000 to 2010, if you see, when the tech bubble burst, US market fell, our market fell. When World Trade Center was blown up, their market fell, our market fell. Global financial crisis, their market fell 25-30%, our market fell 55 to 58%. So every time the stock market declined, in complete sympathy or empathy, our market also declined. But ultimately, at the end of a decade, Their market delivered what their companies delivered. Our market delivered what our companies delivered. So there are two, three lessons in this slide which I want to share with you. When the US was booming, we didn't benefit. What is the reason? Domestic conditions. So in the long run, the explanation for stock market performance is always the domestic conditions and the corporate performance, nothing else. But in the short term, stock markets get correlated, and over the long term, they will ultimately do what the economy and the corporates do. So I think this is what one needs to really keep in mind. I don't think that US recession means recession for us. I don't think that a boom in US necessarily means a boom for us. Yes, if the US is booming, in fact, experience shows that if the US was booming, emerging markets actually underperformed. Because if the largest economy in the world is growing 3-4% year on year, then other economies will struggle to attract investment. And in 2000 to 2010, when US did badly, that was probably the best period for emerging markets. So I think that we are not ultimately what we will do. Ultimately, what our stock market will do will depend on our domestic performance and not so much on US performance.
Can become an opportunity, blessings in disguise for emerging markets to do well, both on the corporate earning sides and sort of increase their market share and do well as an economy. So now, particularly two specific questions, Aashish. One,